Lowcountry Money Talk. We're at the desk. We're ready to talk money. We're joined by Phil Bloyd with Revolutionary Financial Group, our resident expert here. Thanks so much for being here.
Good to be here, Jessa.
I am excited about today's show because I really need to get caught up on what's going on.
Sure.
And I know just the man for the job.
All right.
For our folks at home, we're talking about retirement, and we're going to discuss a little bit about what it is that you really need to save for retirement. But first, we need to understand what's going on.
Sure.
So
update.
Give us an update.
Right. So the Consumer Price Index came out. It was for June, right around 3% inflation. Now we have to think that the energy costs have gone down a little bit, the gas prices, so that's probably helped a lot because a lot of that is figured around that. But just remember, it's 3% year over year on top of the 9% it was last year.
That's the thing. It's tricky because 3% sounds not too bad, right?
Right.
But we're already up.
Right, so it's on top of the 9,
yeah.
so I mean, that's still a big margin. So when we go to the grocery store, we still notice that everything's very expensive still.
Absolutely. Yeah. Oh yeah, you check out $200 doesn't get you but a few bags these days.
I think I got like 3 bags for $150 or something.
Yeah, it's not what you're expecting. We should be practiced at these higher prices, right? But it's still giving me sticker shock.
Yeah.
Okay, so let's talk a little bit about that in terms of just what's happening in the stock market and how what's happening with their bottom line.
So let's see, the first 6 months of this year, pretty good for the stock market, although concentrated in a handful of stocks, which we don't like. We do and don't. We like them because maybe we have them, but we want more of a rally. So now we're hearing a magnificent 7 stocks or things of this nature. So these handful of stocks have added so much to the NASDAQ 100 index that they're going to rebalance it. Well, we don't hear that very often. So I believe the 24th they're going to start that rebalancing or whatever. So we'll see what happens there.
Okay.
I don't know that I like that concept, but we'll see.
Okay, so there's a handful, 7 stocks that are really doing well, and that causes this shift, this rebalancing. Okay.
Well, it's starting to spread out a little bit more into some others, so we would like to see more of that. Don't get me wrong, I'm happy that we're up in those 7, I would say 7 to 10 stocks, but now we're seeing it kind of spread to some others. So we want to see more of that, where more of the market sharing in these
some options
moving
for
up
people.
Of these stocks.
And up, I mean, they are up, but they're up from a loss.
Yeah,
right?
so just remember the NASDAQ last year finished the year down about 35%, and the S&P 500 index was down about 20%. So just because we're back 35% when we were down 35%, that doesn't mean zero. Okay, you're only up a third of what the loss was. So if you participated in that whole downturn last year in that index, you still got quite a ways to go.
You haven't bounced back
Not yet.
Okay, but we're seeing some rally in the market, and hopefully
we like that.
Yeah, we like that. All right. So let's talk a little bit about these two sort of things in terms of how much do we really need in retirement. There's a survey that says, and this is about belief, that Americans believe they need $1.27 million in order to retire comfortably. What say you about that number?
Well, it's on an individual basis. And the great question you had, is that per person or per couple? It doesn't really say. So, what I would say, retirement is a couple thing or an individual thing. So some people have a huge pension in retirement, and that takes care of them, so they don't really need to dig much into their savings. Other people may have little or no pension, and they have to go more into their saved investments. So our viewers will know which one of those they are, but we would need to do that income report, the Revolutionary Financial Review, and see what that looks like.
And it's so smart to do that. Just really dive in, take a look, and you need to know where you're at, so you know where you need to go. Super important. Can be scary, but it's important to do that. All right, well, we've got a lot more to talk about here on Lowcountry Money Talk. We hope you'll stick with us after the break. We're back after the break here on Lowcountry Money Talk. Phil Bloyd is with us to walk us through, well, really just making sure we have enough money to retire or last through retirement.
Yeah.
Nice to see you back
Good to
from
see
the break.
I made it, didn't run out, still here.
I'm always glad when we have you still back when we return. But that's good. We got a lot to talk about. So this is a topic that, of course, every person who is entering retirement or in retirement is thinking about. Do we have enough money? What is that number? Is it going to last? And there's lots of concerns that are playing into these questions that we're having. Obviously, the state of the economy, inflation, we were just talking about before the break. What are the future tax increases going to be? So let's discuss this. How do we know when we can retire? And how do we know if we have enough money to stay in good position?
Well, first thing we want to do, Jess, is we want to run that income report. Take a look at expenses, inflation, what you would have coming in Social Security, potential returns on investment, all this. And we want to see if that projects out well into your retirement, maybe into your 90s. Some people are more optimistic, but I mean, we look at that running past 90, 95, we feel pretty good about things if we see that. If we see some red or some shortfalls before that, then there's some work that needs to be done. So we want to look at that. We'll take into account, of course, your expenses. Now, normally the inflation factor will look at about 3%. So this year you could see, and last year, that's kind of changed things a little bit. So we may need to readjust those. The other thing, we've had a big dump in the stock market, so that can affect things. An increase in taxes, all these things can, they can affect that projection. One of the things that I ask people a lot of times in my events is how many of you, if you were healthy and happy and able to travel and move around, how many of you would love to live to be 100, or I would say 90, but we'll say 90 to 100 years old, they'll raise their hand.
Yeah.
And I said, okay, let's say that you were broke and had no money.
Right.
Takes the fun out of it. The hands go down.
Absolutely.
So one of the largest fears that our retirees have is outliving their money. They want to cash the last check on the last breath.
Right.
I don't see that happen very often, but it is a concern.
Yeah, absolutely. Okay, well, this is a good time to really have that analyzed. And, there's never a bad time to do it, but I think it's a good time to just stop and get a reset. You mentioned the Revolutionary Wealth Review. That's something that you can actually call the office today and have that done. Rachel will help you get that set up, and you're really, with that review, going to find out the answer to the big question. Do you have enough money to last?
Sure. And Jessa, what I would say, if you haven't had a review done lately, since the inflation, since the dip in the stock market, you may want to update that a little bit.
Yeah.
Because it may have changed some.
That's a great point. With all the changes that we're seeing in the market and in the economy and all the things going on, maybe you've done one, maybe it's been a while, but where are you really? And it might be different than you think.
Or maybe you have no idea what we're talking about. And then you really need to have a review. So with the change in the market, the inflation, I would recommend really this is the time. If you haven't had a second opinion, now would be the time for it. Also, if you're not really sure whether you've been working with a financial planning person or retirement planning. So if you're within a few years of retirement, you really should change your focus from financial planning. Financial planning, saving up, contributing to all these pre-tax vehicles maybe you did over your working years. And now you need to focus more on as you're taking distribution or income out of these assets, because taxes will be more of a factor then.
Yeah, boy, and we talked a lot about that a couple episodes ago, and what a huge impact that can have. So if you don't have a tax plan, that could be tricky.
Yes.
And that's, of course, you have your eye on all of those things. So Revolutionary Wealth Review, you can call Rachel at the office. If you have investable assets of $500,000 or more, that would make you a good candidate. And everybody's a good candidate to watch us after the break, don't you think?
Absolutely.
Okay, stick around. We'll be right back. here on Lowcountry Money Talk. If you're just tuning in, well, we're really talking about the big question that we all have going into and being in retirement, which is my money going to last? So Phil Bloyd's helping us unpack that question. It's a lot to discuss.
Sure.
Thanks so much.
It's important, very important.
Very important.
Very
this
concerning.
Is what you do every day. And all right, so we've talked a little bit about what's happening in the economy and some of the numbers that have recently come out in terms of inflation. So important factor, right? We're talking a little bit about how to know if you have enough to last or not. And of course, we talk about the stock market when we're talking about saving for retirement. It's a great plan for long-term investment and usually has higher returns than other options. So it's been a go-to. That being said, as we start getting older, we start getting into retirement, we start being more conservative.
Sure.
We start wondering more about how are we going to keep enough wealth. So we kind of are switching between accumulation and preservation.
Yes.
And that's the question is, what's the balance there?
Right. Well, first of all, I have a few, very few, that they don't want anything to do with the stock market. And, we have alternatives for that as well. But then on the other hand, I think for long-term growth, that's going to be our best average return over the years. The thing we have with retirees, they're like, well, I don't have enough longevity to make up huge losses in the stock market, see? So I like that balance of that Rule 100, Jessa. So if we take that age and let's say we have a retiree that's 70, maybe we look at 30% of that into the equity growth part.
Right.
30%, did I say 70? So 30% into the growth part. Okay. So we want 30% into the growth part, and we want to be more on preservation with the other 70.
Right.
So here's the thing. When the market does what it did last year and took that big sell-off, we don't want to be selling those positions at a low point. Okay, we can rearrange some things, but we don't want to be selling low.
Right.
We want to buy low, and we want to sell high. So unfortunately, the fear and greed that people have, the market moves on fear and greed, and you get that with the media, just ongoing. Scares you to death.
Yes, it does.
My wife's like, turn off that television. I don't want to hear it. I said, dear, even you turn it off, it's still going on.
It's happening, whether you're paying attention or not. Yeah.
Right. So we want to make sure, I think the best idea would make sure that we have the right exposure, but not, because if we say 30% and the market takes that downturn, we can take our withdrawals out of the preservation side.
Right.
And then we can leave those equities to realize whatever the average, the long-term average of the market.
So it's not an either or, is basically, you don't just flip from, accumulation phase to preservation phase. You're constantly making adjustments as you age, which is very easy to do by following that rule of 100, at least on paper. Now, what about potential consequences for people who are a little too conservative in their investment approach?
Yeah.
What do you tell those folks?
Well, first of all, there's two schools of thought on that. One person say, well, I have so much money that I don't really need it all. So I'm not going to take the risk because I don't need to. And I'm not going to argue against that maybe, but you may have another person with another school of thought that says, I have so much money, I don't need it, so I'm going to take more risk.
Why
so,
not?
There's a different ideology there. A lot of that depends on the individual, but as long as the person understands the risk that they're accepting, and I will show them, the preferred route, but it will end up what they want to do.
Right. Well, and everyone's got, like you said, their own comfort zone. And if you have an abundance going into retirement, you have the leeway to be able to make those decisions.
Yeah.
That's nice.
And
that's guidance decisions.
And some of those are like, I know the market's down, it'll come back. And it's ideology, as long as that doesn't bother them. But sometimes people tell me one thing and I see another, and they're just freaking out about it. I'm like, well, you told me that, you were okay, then you wanted more exposure, but you can't deal with it. So obviously you're struggling within yourself. So we need to straighten that out.
You got to be able to sleep at night, right?
Absolutely.
Okay. Well, Phil, we got more questions to ask you. We're going to do that after the break. We hope you'll stick around and get those answers with us. We'll be right back. right, we've made it to segment 4. This is the final segment in our show.
Yeah, goes fast.
It goes too fast sometimes, but you know what? That's good. We're answering good questions.
Yeah.
You're answering good questions. We're talking about retirement, having enough money, and all of the things that goes into really what that entails. And just some of it is, we're talking a little bit about just mentally, where you feel comfortable. Okay, so we're going to ask some more questions here for Phil, and I want to talk a little bit about just steps, just practical steps that retirees can take to help protect their retirement from the impact of what we've been dealing with here lately over the last several years of this stock market volatility. How do we protect ourselves against that?
Well, I always tell people, Jess, it's like we can't determine what's going to happen with the stock market. You know, it's going to do what it does, but we can control how much we want to subject to that stock market. So again, we'll go back to that rule of 100. We'll subtract from our age. So we say we have 30%, we'll say on a 70-year, we have a 30% exposure.
Yeah.
So we'll say, okay, I'm going to take 30% of my life savings and I'm going to expose it to the stock market and what's going on there. The other thing is I do a managed approach. So I'm managing the funds. I change things based upon what's going on with the market. A lot of people say, well, you know, I buy the index and I just leave it alone and it'll work its way out. Sure, yeah, you could do that. But I like to take a more hands-on with management. So I'm going to change around the investments based upon the market that we're in. Not saying that we'll come out of the market altogether, but we may change how much we expose to different sectors.
Right.
You know, like last year, the gas, the oil sectors were way up. You know, some of those oil positions were just off the charts. So we would want some exposure to that, maybe a little bit more. But on the other hand, the technology sector was really getting wiped out. So maybe we want less exposure to that. So we still want a managed approach to our 30% in the market.
Just riding the average.
We just don't want to we'll just leave it in these ones, knowing that these sectors aren't doing well, and we'll just follow them down. I always tell people, you know, I may not learned a whole lot when I was a little kid, but I can tell you my mom told me, you know, when a train's coming, don't sit there in the middle of the tracks and wait on it.
Get out of the way.
Get out of the way.
Well, and this really shows when you're talking with your clients, because even if, you know, it maybe wasn't their best year ever, it's not as bad as it could have been, because it could have been really bad.
If you just leave it to where it was and the market changes and you're not kind of changing your investments with it, probably you're not going to have as good of a return as maybe possible. So we still have that 30% exposure, but we still change the sectors and what we're exposed to in that market.
Okay, so before we leave today, let's talk about the implications of making some of those mistakes, right? So if we're making some of these common mistakes that retirees can make during these periods where the stock market is volatile, it's tricky to know what's going to happen, and it's tricky not to misstep. What are some ways we can sort of mitigate these errors?
Sure. So Jessa, one thing we always talk about on this show is the income buckets for retirement. That's the difference, I think, from financial planning and retirement planning is the income buckets. Where do we take our income? From the capital gains bucket, from the IRA 401k deferred bucket, from a Roth tax-free bucket. So to make a really bad decision would be, let's just say I have too much money in my checking account and I need, say, an extra $10,000. But I like to look at a checking balance of so much. But I'm like, well, I'm just going to go ahead and take that $10,000 out of the middle bucket, the IRA income bucket. Well, when I do that, maybe I have to take out $12,000 instead of $10,000 because of taxes. And maybe I should have just took it from my checking account when I already had paid taxes on those funds. So this is one thing I find a lot. So.
Yeah. Well, and also you're taking at a time, right, when there's a downturn. So not a great time to do that. Okay, so if you're wondering where you stand, it's a good time to get a Revolutionary Wealth Review. And I will tell you, it is so nice to have the folks over at Revolutionary Financial Group just walk you through where you are in your financial picture. You can call Rachel at the office to get that set up. They'll take great care of you. And thank you so much for watching. And thank you.
Oh, you're welcome.
We appreciate it.
All
We'll
right.
see you next time on Lowcountry Money Talk.